watch out for all these stocks. But another mid-cap stock that came out with its set of numbers was Speciality Restaurants. We have with us the CFO, Mr. Rajesh Kumar Mohta, who joins us currently. Hi, sir. Thanks so much for joining in. Just taking a look at your numbers, it wasn't such a great set. Top-line growth of around 6%. Could you help us with some details? What was the footfalls? Could you give us maybe your same-store sales growth? Could you elaborate on the top line itself?
Here, the top line increase has been because of the opening of restaurants. We have been trying to maintain footfalls. That's the only reason why we have been not increasing our end prices despite increase in the food cost. But continuing with this particular trend, we have opened almost 13 restaurants in the last 12 months.
Okay.
The operating leverage has worked the other way around rather than working favorably for the organization. That's the only reason why there is an impact on the margins. But going forward, since getting into a good season like October, November, December, we look forward to better months to come.
Okay. Mr. Mohta, we'll just try and reconnect with you. The line is a bit scratchy. That stock is down nearly 4.5%, so quite disappointing, the set of earnings. The growth rate has slowed down to 6.3% this quarter. And remember, just in the previous quarter, its revenue growth was nearly about 14%. So that recovery in consumption discretionary spend continues to remain elusive, and it's gotten advanced to, the hope has gotten advanced to another quarter. Margins too have cracked below the 5% mark. So from 9.3% in the comparable quarter of last year, it's come down to 4.9%, and that's driving a 58% decline in the profitability. So a disappointing set of earnings. We managed to reconnect with Mr. Mohta, the CFO. Afternoon, Mr. Mohta, and thanks so much for joining in. It is disappointing. Your revenue growth rate has slowed down to 6%. That's not a rate that we've seen in the past many quarters. Your margins too are below the 5% mark. At a time when the demand is so muted, would you consider slowing down your expansion plans? Do you still maintain that you will open 10 to 12 restaurants this year?
See, what had happened, we were expecting better months previously with moderation and inflation, but effectively the things have not changed on ground. So we continued with our expansion, and from October 2014 till September 2015, we have opened 13 restaurants. So it's a question of time. But yes, looking at things which are going to unfold in months to come, we are working on a strategy that we would choose locations which are short rather than getting into that particular number. But 10 to 12 restaurants already opened in this particular financial year. There are a couple of leases which have already been signed, but going forward we are getting into a strategic decision to open only locations which would work favorably for us.
All right, Mr. Mohta, then talking about opening up more amount of outlets, could you tell us how are rents shaping up? Are you getting some kind of bargaining power in terms of your lease rentals? Also, the new rentals that you'll be signing, do you believe that, in fact, we know that the market is in oversupply, so do you believe you can see any kind of benefit in terms of those expenditures? And also, you're saying the top line growth is not growing so much, but your employee cost has ballooned up close to around 16%, at around 21 crores per quarter. You expect your employee costs to stabilize there?
See, as far as rental renegotiations and rentals outlook, we have been able to negotiate better rates. Some of the properties which we had discussed earlier are coming back to us with lower rentals and the target rentals which we look at. Coming to the question of staff cost, what has happened, the opening of the restaurants, we continue to operate on that particular number with a fixed set of people working in the restaurants. But the revenues in that particular restaurants are not commensurate with the percentage cost. That's the only reason why you find there is a trigger in the staff cost. But once the revenues of those restaurants get into the system, we would be able to get into a lower number on percentage to revenue basis.
Okay. So give us a sense of how the coming 2 quarters will look like in terms of revenues, as well as the improvement in margins from the current 5%.
See, if what we look at Q3, October, November, December happens to be one of the best quarters for us amongst the 4 quarters in any financial year, and we are looking forward to better months to come in. On that very basis, we have done this kind of an expansion, and we look forward, yes, things would improve, but on ground, once we get into the footfalls, the biggest challenge has been the increase in the end prices, which to neutralize the cost impacts. But yes, October, November, December looks better.
Any numbers?
So it's difficult for me to say at this point because previous quarter also we did good in July, August, but September was a dampener for us which had impacted the overall quarter numbers.
All right, Mr. Mohta, let's hope that in fact this festive cheer can bring about some results as well. Thanks so much for joining in today and giving us all those details. But time to slip into a short break. On the other side, we'll be joined by Samit Chavan as well as